Refinancing your mortgage can sound like an easy win. Lower your monthly payment, save money, done, right? But what if that lower payment actually costs you tens of thousands more over time? Welcome to Quick Financial Concepts, where we help you make smarter financial decisions by asking the right questions first. Today, 5 questions to ask before refinancing your mortgage. Refinancing means replacing your current mortgage with a new one, usually to lower your rate or monthly payment. But here's what many people miss. Lenders often structure refinance deals to make the payment look attractive, while quietly increasing your total cost. And one of the biggest traps? Rolling closing costs into the new loan. Question number 1. Am I lowering my payment or just extending my debt? This is the first trap. Ask, is my payment lower because of a better rate or because I reset the clock? For example, you're 10 years into a 30-year loan. You refinance into a new 30-year loan. You just added 10 years of interest back onto your life. Always remember that in the first 10 years, the majority of your payments go directly to interest and not your principal. Lower payments don't always mean a better deal. Question number 2. What are the total closing costs, and how am I paying them? This is where my personal experience hits hard. I was asked several years ago when I refinanced to roll the refinancing costs into the loan. There was no way I was going to pay interest on the fees, so I paid it up front. So ask, am I paying these fees up front or adding them to my loan? The typical refinancing costs are lender fees, appraisal, and title and closing costs. Here's the trap. Rolling $5,000, $10,000 into your loan and paying interest on it for 30 years. While you may have lowered your interest rate, you also increased your total cost over time. Key insight. Why would you pay interest on fees for decades? Paying upfront, if possible, can save you significantly in the long term. Question number 3. What is my break-even point? Refinancing isn't free. You need time to benefit. Ask, how long will it take for my monthly savings to cover the cost? For example, you save $200 per month, refinancing costs equal $6,000, so your break-even is 30 months. If you move or refinance again before that, you lose money. There are many online calculators to help you determine your break-even point. Question number 4. What is the total cost of this new loan? This is where most people don't look or don't pay attention. Ask, what will I pay in total over the life of this new mortgage? Compare the total interest on current loan and total interest on the new loan. You might lower your monthly payment, but increase your lifetime cost dramatically. Question number 5. What is my goal with this refinance? This is where clarity matters. Ask, why am I refinancing? Is it to lower my monthly payment? Pay off the loan faster? If you decided to change from a 30-year to a 15-year loan, or access equity, cash out refinance, if your goal isn't clear, you're more likely to accept a bad deal. Now, today's final thought. Refinancing can be a powerful financial move, but only if you understand the full picture. Before you refinance, ask, 1. Am I lowering my payment or extending my debt? 2. How am I paying the closing costs? 3. What's my break-even point? 4. What's the total cost of the new loan? 5. What is my actual goal? Because the real goal isn't just a lower payment, it's paying less money over time. If this helped you think differently about refinancing, subscribe to Quick Financial Concepts. We break down real financial decisions so you don't fall into costly traps. And remember, if the deal looks too good on the surface, look deeper.